Hey there, and welcome to Real Investment News. I'm Mike O'Neill. So it looks like investors are once again shrugging off those trade war fears and headed back into the markets. As you can see, the S&P is up 23 points, the NASDAQ is up 54 points. As a matter of fact, when you take a look at the big chart on this S&P index, you can see that the 200 DMA is continuing to prove a strong baseline for this market. But you can also see how the 50-day moving average, this red line here, is starting to move closer to the 100 DMA. When it crosses below, that is called a death cross or a dead cross, a signal for investors that we might be entering a bear market. But both are still holding well above the 200-day, so it's too early to make any big decisions. But it's situations like this that Lance wrote about in his newsletter over the weekend, Bulls Hang On by a Thread. In it, he spoke about the trade war fears that had investors so nervous last week and how President Trump didn't seem too concerned about what a trade war might do to the market. Take a listen.
I'm not saying there won't be a little pain, but the market's gone up 40%, 42%, so we might lose a little bit of it. But we're going to have a much stronger country when we're finished.
So let's talk about a potential trade war. First, they are almost never economically beneficial because they raise the cost of materials, which then hurts the producers and increases their production costs, and that also hurts their profit margins. That means that they have to raise prices on the goods and pass that on to the consumers whose wages are not going up because the producers are needing more money to buy more materials. It's a vicious cycle. And as for the president's claim about the market being able to endure an adjustment, well, maybe. This is a look at the S&P since 2009 when this bull market began, and you can see how it set a very solid trend line. But then it rushed upwards in February 2016. It set a new accelerated trend line. And we're going to focus on this section here. So as we zoom in, if we had followed along the original trend line, the market would probably be around 2,100, but we peaked in late January. Look at that, over 2,800. And even with the drops we had last week, we still closed above 2,600 on Friday. So yeah, in a way, the president is right. We could still lose, look at that, almost 19, almost 20% in value and still be in a bull market. But that downward momentum would be dangerous. Drops like that could trigger margin calls, weigh on asset prices enough to trigger a credit issue in the high yield market, create a pension run where people are going to demand money from their pensions early for fear it might not be there when they need it, or even a combination of all three. So yeah, the markets seem to be doing well. Today they are closing higher. That's nice, but when the bull market is hanging by a thread, it's not going to take a lot to see it fall. Now, Lance has a much deeper analysis on this at realinvestmentadvice.com. You definitely have to check it out. In the meantime, thank you so very much for watching. Be sure to follow us on Facebook, Twitter, YouTube. Check out our past reports at realinvestmentnews.com. I'm Mike O'Neill. We'll see you again tomorrow morning.